You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
My name is Mark Longo from theoptionsinsider.com, and welcome to TWIFO, This Week in Futures Options, the program here on the old network where we break down, like the name says, the week that was, and indeed still is, from a futures options trading and volume and unusual activity and volatility and rent and skew and all that fun stuff. So if you ever said to yourself, well, you know, what's going on over there in them thar hills, the futures options hills? What's trading? What's lighting it up? Is there any vol to be found out there? Well, we got the answers for you. And, of course, you can join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixlr, MIXLR. Just click on that link that we put out there, or if you've seen it before or grabbed it for any of our previous programs, same link all the time. Just fire up that link, and you can join us live with your questions, your comments, your insights, your pearls of wisdom, and all your other fun nuggets on all things futures options. Of course, you can always grab us, theoptionsinsider.com, iTunes, Stitcher, TuneIn, iHeartRadio, all that fun stuff. Wherever you find your finer podcast, just search for This Week in Futures Options, and we shall be there, including via the App Store, via our app. It's all there as well. And if you have questions, comments, we'd love to hear from you guys. At Options on Twitter, at Options on StockTwits, questions at theoptionsinsider.com, live. You can send them in, no shortage of ways for you guys to make your feelings known to us. We love it when you guys do that. You guys have all sorts of interesting insights. Maybe we'll get to some of those a little bit later in the program. But first, let me introduce my cohort, my partner in all things futures, options, crime, Mr. Nick Howard, the founder and creator of Quick Strike. Mr. Nick, welcome back to the TWIFO program. Nice to be on with you from the old studio again and not beaming in from parts unknown like I was last week.
Yeah, I was pleasantly surprised that we're doing a live show today because I thought we were going to do another recorded one. So doing a little dance under the desk here because we get to speak live and hopefully get some listeners and not getting shut out by the NCAA right now because it certainly looks that way.
We do
at this point.
We do have some counter programming, shall we say, on this. Plus, it is St. Patty's Day here, of course, the national holiday of Chicago. So all of Chicago, I think, taking the day off. The market's certainly reflecting that, at least in the broad equities and indexes, with most things pretty quiet out there on the old street. But things were lighting it up this week. So let's get to it with the product I think a lot of you guys want us to talk about this week. That is, of course, all things crude. You know, crude was a big driver of last week's volatility, last week's action. We saw a big movement out there in crude. You know, we've kind of seen crude doing that dance for quite some time now, certainly since most of the beginning of the year here, of that 50 to 55 range. Will it break it through to the upside? Will it break through to the downside? Well, last week we got our answer. It broke through to the downside, and we saw a nice pop in vol. I think a welcome pop of vol, a little welcome sign of life out there in crude volatility, because it had been, shall we say, languishing for quite some time, and we know a little bit of shot of life, a little bit of shot of vol, a nice little shot in the arm for all things crude options, and the traders out there who like to take advantage of that. And it was an active week. Really quickly, I should say too, we were, first off, if you want to follow along with Nick and I, as you do every week, cmegroup.com/TWIFO. Now it works. TWIFO. They fixed it. They added the F. So you can go over there and follow along with all these nuggets and pearls of wisdom that Nick are going to show us. You can generate your own reports on the fly completely for free, so you can see exactly what we're talking about here. And speaking of our friends at CME, Nick, I had planned. I just came back from the big Futures Industry Association conference, a big annual get-together of all things derivatives. All the global exchanges and trading firms and brokers all descend on Florida in mid-March to talk a lot of regulation mostly, but a lot of other things as well. And I had set up to chat with a lot of our friends over there at CME, maybe even cut some of those segments into the show this week for the CME hot seat. But unfortunately, the weather, Mother Nature intervened. So no CME folks on the old CME hot seat. Just you and me this week, Nick. You have to put up with me for one more week here. But there are some interesting nuggets worth talking about before we even get into the hot strikes and all that fun stuff. For example, WTI, as you might expect, has been lighting it up of late. In fact, historically, 3 of the top 5 trading days in the history of WTI occurred just in the past week. If you're wondering what the number 1 day was, it was November 30th, surprise, surprise, of 2016, a.k.a. OPEC cut day, OPEC freeze day, where they did about 580,000 contracts. Again, number 2 was March 9th. 570. Number 3, March 8th. So a little bit of a theme there. 518. Number 4, November 29th. So this week in November, pretty much dominating the charts. 460,000 for number 4. And the number 5 day out there in WTI was March 10th with 440,000 contracts. The futures also lightened it up as well. CME setting a single-day WTI futures open interest record back on the 14th with 2.24 million contracts. Yes, I said 2.24 million with an M. That shows you just how much size is rocking and rolling out there this week. And it was a rock'em sock'em week, and Nick, not perhaps quite as aggressive from an underlying net movement as we saw last week, where we were still kind of in the teeth of the sell-off last week, and in between sirens and birds and all the other things that were intruding on the show last week, we were kind of speculating if this sell-off would continue, or if we're going to see a bit of a halt and a bit of maybe even a rally. And that's exactly kind of what we saw. The futures kind of halted and then popped a little bit, not a ton, but a little bit towards the end of the week, so kind of halting that slide, breaking us down a little bit shy right around that 50 handle, depending on where you're looking out there in the term structure. So after seeing all that nice juicy vol come rushing in last week, it kind of went right back out the door again, which is not surprising if you're going to see these sell-offs. Unless the sell-off can continue, if it halts or even reverses a little bit, you're going to see that vol come in. That's pretty much exactly what we saw out there. I'll let Nick get to the quick skew in a little bit. That's been kind of interesting to watch as well. You guys can pull that up by yourselves now in that column. Let's look next to the 25-day risk reversal in the volatility column over there if you're doing cmegroup.com/TWIFO, and you will see 25-day quick skew now. And that will show you exactly what's going on out there, as well as what the change is from the week before. If you look at that, you'll see some market changes going on out there in all things skew. And speaking of what was lighting it up, first off, OI up about 7.5% this week, so another banner week out here to be in the crude futures options business. And number one with the bullet in terms of months was again the front month out to May now, with about a little over 50% of the overall volume. Not surprising, again, that's kind of the breakdown we typically see out there in all things crude, with the front month being hot and heavy for most of it. Double calls. Matt, that may surprise some listeners. The double calls lighting it up, taking the number one spot this week. So you've said to yourself, hey, what was the number one hot strike out there in crude this week? It was the May doubles, 55 calls, 29,000, almost 30,000 contracts lighting it up, including a big chunk middle of the week, which kind of coincides with a little bit of that turnaround there. 13,000 and change on Wednesday, 11,000 on Thursday. The lion's share of both of those opening. So interesting. We kind of talked a little bit last week, Nick, about some surprising call activity, and I think this week you can certainly say the same again this week. A lot of call activity. In fact, calls lighting it up. Calls the order of the day pretty much across the board. Puts were active too. 45 puts doing about 22,000 contracts, but double calls in the front month, 52 calls with about 22,000 contracts lighting it up. Again, a good chunk of those on Wednesday and Thursday. A good chunk of those opening on Wednesday as well. The 50 calls, a little less optimistic. 50 calls, 17,000 and change. And then I think more interestingly as well, Nick, kind of action in the calls all the way out across the term structure. Maybe some of the bulls seeing this as an opportunity to get in cheap. If you want to see this for yourself, listeners, if you're over there, cmegroup.com/TWIFO. They both work, TWIO or TWIFO. Click on the expirations tab on the top there, and you'll see Jan to December 2017 on the left. Next to it, Jan to Dece 2018. Just click on some of those boxes there, and you'll be able to follow along with what we're talking about here, which is longer term paper, including end of this year, close to it. We saw some of the Dece 2017s, including the 52 calls, lighting it up for about 6,000 contracts and change. A good chunk of that closing, though, so someone giving up the ghost there, including a lion's share of that on Tuesday. So perhaps a little bit of capitulation. Again, not entirely surprising. Not all bulls opening out here, but going all the way out to, looks like, June of next year, the 50 halves with about 2,000 contracts and change, 2,200. A good chunk of that opening as well. So someone reestablishing out in June of 2018 with about 2,200 calls. Also, the double calls all the way out in Dece of 2018. The doubles, so the 55s and the 51s, both lighting it up. Maybe I'd say it's a vertical, but they went up 2 separate days. So unless he was a poorly timed vertical, they were separate trades. About 1,500 of the double calls going up on Wednesday, all of that opening. Another 400 and so change today. And then 1,600 of the 51 calls going up on Thursday, about 600 or so of that opening. So some open interest already on the 51s there. But still, a lot of longer-term opening call paper out here as well. So an interesting week. Some capitulation as to be expected, but still, Nick, the order of the day is calls. The bulls, at least the calls, are in full force here. So you think the people are prepping for a bit of a turnaround? Certainly longer term, that does seem to be some open paper out there. What's your take here, and what caught your eye this week in all things WTI?
Yeah, I know that was something definitely was pretty noticeable from looking at the report. The 55s, that was a lot of open interest increase as there as well. So 30,000 went up over 50%. Actually, a 78% increase in open interest for that particular strike. But what caught my eye just in general, the put call ratio from a volume standpoint was definitely pretty flat, with a little bit of bias to the calls across the board. But I think, and I just tweeted something out there. You take a look at the volume for, at least in the May contract, is that you didn't see a huge range of strike trade, right? You really saw where we came from, or where we started maybe, or just we went from the 55 down to the 45 primarily in terms of the strikes that we saw trade. So I think what we can say based on just looking at that range of trade is that people still aren't convinced that we're moving significantly out of the range that we've been talking about, the 45 to 55 for quite a while. We were talking 50 to 55. We kind of broke through. 47 took over as sort of the high OI strike for several of the months. Then it was a 45. So I think we're looking at our new range, 45 to 55. And what does that mean? We like we've said, and I think it's been following through pretty well. Like last week, I have this week in options open from last week, and we were up like 8.5 or 8.25 vol in May and 6.25 in June, and now we're down 5 vol in May and 2.5 in June. And what you started to see when the vol got really bid this past week is the vol term structure flattened out pretty good. Prior to that, there was some spread trade available, and I think we did mention at one show how you can buy the May or the June and sell some of the longer dated stuff given the width of those vol spreads. And I think what you're seeing is it's kind of going back to that location. So probably something to keep an eye on is take a good look at where the term structure is, how it's looking, and if you think a move's coming, it might be time to put some calendar spreads on, meaning buying the short dated, selling the long dated, which makes sense because shorter data is going to give you more gamma, more bang for your buck on an underlying move. So, but we are pushing that back down. May down below 26 vol. It was up almost to 31 last week. So you're in pretty significantly. The middle months are hanging on a bit more. But not that much, and that's pretty much expected, right? When you see a big move, you're going to see the gamma months or the front months get a little bit bigger boost from a volatility standpoint. But this 8.25 to 5% down now, and there's not a great amount of decay necessarily in the May just yet. But I think it. I was sort of looking to see if we traded above 50 at all, or if we settled above 50. We did not get there this week. I think that's sort of what people are thinking, because you saw such a big push for these upside calls. So I think people were looking for that. People took that break, took it with a grain of salt for the most part. I know that there's been talk about the crude following the vegetable oils and all that kind of thing. But, I think we got as far as we're going to go. We tested some lows. We went through the 48 strike, got into the mid 47s, and now we're right back up where we were, only up 35 cents or less in the contract itself for the week. But, vol got in pounded, maybe not the right word, but it got softer. And it just goes to show you that if there's no follow through, you sell the volatility, right? It's just classic. It got bid up, you got an opportunity to sell it, and now you sell it. So one other noticeable thing in there, outside of, you mentioned pretty much all of the activity in the strikes pretty thoroughly. And as I mentioned, we tweeted out the fact that there's a table out there that's showing the May distribution of the volume this week. But we saw, 31 days left in the May contract. We saw those upside calls get significantly more expensive. They were 7% cheap to the money. Now they're only 2.5% cheap to the money. And you're looking at that's like 2 vol or something like that, the way it looks right now. So there was a little change of heart, and I think across the board, the calls got a little bit more bid to them, and the puts got a little bit more offered them. And if you look down, if you go right now, we don't give you the both view. Well, we give you both views in the TWIFO. No, I don't think we do. We give you the current view of where the quick skew is. But if you go back and look at last week, you can see this week versus last week, and you're going to see that there is puts getting a little bit cheaper to the at the money and calls getting a little bit more expensive. So again, you take a look at those ranges, see where that spread is going, that call to put spread from richest to cheapest at the money, and there is some opportunity there as well. So what do we take away from this last couple of weeks? We take away from a flattening term structure. Probably going to mean that there's some movement in the front, so it's going to catch up to the backs, and then that term structure is going to get steepened a little bit in the first few contracts after we settle into a range. So I would imagine that, given that we didn't get much follow through this week, that we'll probably settle into this 49 range. We might, if we start pushing back up towards 50, which I think we're going to. There was a lot of activity in that strike as well. So we start trading in that 50 to 55 range again, and I think you're going to see the vol term structure just kind of parallel shift downward until we get a break. I just don't, fundamentals aside, news aside, I just think that we're in a trading range here, and you're probably, vol probably is not going to do that much damage if you sit on the short. But at the same time, if you do get long and you do get to move, I think we learn that you got to get out, and it might be time to take a, maybe now that the calls came back a little bit, but if they widen out again, maybe it's, regardless of the direction, maybe it's time to take into account that you do some risk reversals, selling the expensive 25 delta, buying the cheap 25 delta, getting the same amount of, basically being Vega neutral, but taking on a vol spread where you can get some opportunity there if there is some movement. So keep an eye on the vol term structure, keep an eye on the quick skew, and you'll see across the board on the report as well that the skew itself, and it's noticeable just based on or you would expect it based on what I said in terms of the difference in the richness and cheapness, but got very much more positive this week as well. So 30-day option, some interesting stuff can still happen there. Still worth paying attention to that front contract. So next week will be rather telling in terms of where vol is going to go and what skew is going to look like going forward.
Yeah, it's a good point about closing out your vol positions. We said that many times on many of our programs, but it is worth repeating here on TWIFO. If you had some long premium, yeah, you had a good run this week, but if you didn't take it off, you got to do stuff with those hedges or those specs. To quote some of my other friends on some of my other shows, you got to do stuff. You gotta take those things off. A hedge is only a hedge if you actually take it off and take the profits. Otherwise, you kind of just spending money and wasting time. So we talked about this last week on the show. We didn't expect this crude spike in volatility to last. If we continued hovering where we were, even rallied a bit, and that's exactly what we saw happening. So hopefully, if you had your crude puts, you're one of these people out there who has been paying up for the last few months for all things WTI downside. If you had it in your back pocket, well, first off, ballyhoo to you. You were on the right side of that trade, but hopefully you took it off in time, because otherwise you kind of missed your opportunity. So this is interesting stuff. Again, there are opportunities if you do want to get long vol in the long term. If you do it, with some discretion and nuance, you use spreads to minimize your outlay, that sort of thing. You can do it, but we have seen over the past 3 or 4 months, being long vol in crude has been a tricky and a delicate dance to make work effectively. You got to pick your poison, you got to get in really quickly, and then get out, hopefully, with some of your profits intact. All right, but Nick, we've been talking so much crude. Crude has been dominating the headlines, but it seems like this week gold wanted to maybe fight back a little bit, maybe try to steal some of WTI's thunder, and I think it managed to do that. And certainly in terms of which underlying was rocking and rolling the most this week, it was all gold all the time, and a pretty strong rally, about 30 or so handles out there in the big future. So we were talking last week, hovering right around the 1200 level. What was going to happen? We're going to continue breaking to the downside. Is it going to pop to the upside? Well, we got our answer. It was popping to the upside to the tune of up to right around the 1230 level. So we're kind of back, getting close to that midpoint of the 1200 levels, Nick, which is, of course, where we see a lot of action unfolding with, will it keep going south of 1200? Will it break north of 1300 or maybe 12.5? So a lot of that playing out here this week as well. Open interest up only about 3.5%. You think it might be a little bit more given the aggressiveness of the underlying movement, but I'm sure the gold bugs were happy either way. They got their nice little pop that they've been waiting for out here. And this one, once again, was pretty much mostly front month with about nearly half, about 46% of the volume coming off in that front month. Also, I should mention, too, we got a nice rally in the futures. So as you're going to see that, vol coming off a little bit. Still, the juice was leaning a bit towards the downside. Vol coming off about half a point to about a point, depending on where you're looking, out there on the old term structure. I'll let Nick get into all things quick skew in a few minutes because there is an interesting little story out there as well. If you're asking what was the number one hot strike out here in in gold options this week, well, it was a close battle, Nick. It wasn't all gold bugs. The number one with the bullet, it was only separated by about 22 contracts, Nick, for the number one spot. It was indeed the front month, so the 12 quarters, with 7,600 contracts going up, including the lion's share of those, about 5,000 and change on Wednesday, including about half of that being opening. So about 7,600 of those, followed by the 1,200 puts. So a little bit tighter risk reversal than maybe we're used to seeing, Nick. Usually we see them fairly wide in gold for a variety of reasons. Usually it's like about 100 handles or so, maybe 50 on the tighter range. This is getting even tighter. This is getting 25 handles. So you're talking the 1,200, 12-quarter risk reversal / strangle, depending on how you want to break it down. The 1,200s also lighting it up, the puts, to the tune of about 7,600. A little bit different story here. A lot of these closing, including about nearly 3,000 on Wednesday, about 2,200 on Tuesday, 1,000 of those on Tuesday closing. So maybe some people giving up the ghost and capitulating a bit there as well on the 1,200 strike, saying, yeah, this turnaround, maybe it's got a little bit more life to it than we thought, so they're closing those out. Number 3, 1175 puts with about 5,800, 4,400 of those coming on Wednesday. Again, looks like a little bit of closing paper out there as well. So maybe some of all those people who've been juicing up those puts of late are starting to give up the ghost out there. 1240 is also doing pretty well, about 4,800 of those, including nearly half of those, about 2,300 coming on Wednesday. So an interesting slew of paper. Let me just play around, like I mentioned before, listeners, to change those settings to include all the way out through the end of 2018, because that gives us, we've seen a lot of interesting longer-term call paper out here in gold over the past few weeks. Let's change some of those settings on cmegroup.com/TWIFO to see if we too can see some interesting activity out here for this week. There we go. And there actually was some interesting stuff, including out here towards the end of the year. You can see that in the regular paper with about 1,700 of the 1275s going up this week as well, including also a little bit farther out back in, looks like June of 2018. It's the 1,500 calls. So extremely optimistic there, going up 1,300 times. Let's break those down a little bit, see how they went up. Yeah, they went up pretty much all of those on Wednesday. So interesting out there as well. What's going on? 1,300 of the 1,500s. So, Nick, it's been an interesting story out here in gold over the past few weeks. Is the sell-off going to continue? Is it going to turn around? What's going to happen with vol? What's going on with skew? And what's going on with a lot of these longer-term call plays we've seen going on out here in gold? It's been a lot of things to sink our teeth into. What caught your eye this week out here in the shiny stuff, aside from the massive pop in the futures?
Yeah, we got the pop in the futures, but again, and we've been saying it for a long time now, it's a pop within an existing range, right? So really that never does much for the market itself. So we were down around, we tested 1,200. We didn't do, 1197, I think was where we reached last week. And then I was looking back, and we're really back where we started earlier last week, and we're in the middle of this 1,200 to 1,260 range. So what's catching my eye is the fact that you didn't see a real breadth of trade in the strike range, right? I think we were 1,200 or 1,150 to 1,300 on that, which is available in the report. So not much going on there in terms of real. And again, you could say, yeah, 1,300, that's up there at $75 above where we are. But at the same time, it's not really we've been there in the near past. So it's not really a big stretch. So you're not seeing any 1,500s or 1,700s like we might have seen in the weeks prior. So really catching my eye is the red and the volatility. We would expect it. coming back into the middle of the range. We're also seeing like the skew itself went a little bit positive from being a little bit biased to the puts to, now biased to the calls. And we look at the quick skew, you see that if we look in the May itself, it went from a capital P to a small p. So it went from rich to the puts to cheap to the puts, and the calls stayed firm. So we had a little bit more of a regular smile, or a happier left side of your face smile, with the puts being a little rich. Now it's a little bit more of a crooked or a slanted smile, so just like maybe an upset stomach smile, because people aren't really sure. We didn't get the follow through, so their puts didn't necessarily pay off from a intrinsic value standpoint. But I think we said at the end of last week in the gold, the vol was cheap, buy puts, buy futures, right? So that would have played very well. Even with the vol coming in, you moved away from strike almost 30 handles, and you had probably 25 delta or a 30 delta over 30 bucks. Not so bad. So what else do I see outside of the fact that the calls got a little bit, the calls are pretty steady to last week. The puts got a little cheaper, but you start looking at the 30-day volatility. You look at the May contract is the closest to the 30-day vol. We're really, really, really on our lows for that contract over a long, long period of time. So I think that again, I think the range trade is going to beat up volatility. So we're getting on really, really low values here from an implied standpoint, but those low vol implieds mean high gamma options, even for something like a June contract. So you can be in that. It may not go anywhere. It might lose a little bit in terms of its levels, but if we get that movement, you should be able to scalp that gamma and pay the rent with those options. So that's something to keep an eye on as well, is to see, how low is this vol going to go? And then if this movement continues, you can buy some options. And now we used to say in the floor, you're not buying vol when you're buying the front months, you're buying gamma, right? So you're buying movement. So if you can get some cheap gamma, some cheap vol, you have an opportunity to scalp and to get something out of the. And I'd say not buying it and sitting on it. I'd say buying it and hedging it and trying to move that delta around as the market moves. Be aggressive in terms of rehedging your puts if you go down and selling those back out if you go back up, and vice versa on the call. So that's really it's the red and the vol, which is going to happen trading in the range. It's the steadiness of the skew, so there's still a bias to the upside, and just the overall change in the risk reversal being positive. Positive all across the board in terms of the increases, and still being generally pretty flat calls to put. So from a net vol standpoint. So that's kind of what I'm seeing. And you can see all that stuff on the TWIFO report. Just take a look. It's all in the columns. We're going to be adding some stuff to that this week too, I think, in the pop-ups in the premium version. So this report's going to get better. We're going to give you more like at the money information as well. So stay tuned and keep an eye on it. We're trying to make it so this is really a place that you can sit during the day and just see what's going on in the market without having to bounce around to see vol and risk reversal and volume and stuff like that.
Hang out in Quick Strike, and then check out your own vol levels and then all that fun stuff. Certainly paying the rent out there in gold this week, Mr. Nick. Maybe I think we should have a whole rent chart or something like that. What's paying the rent? That might be an interesting segment to hit on. Speaking of segments, it's time for you guys to hit us up with your questions. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the your feedback, your segment, where you guys get to ask us your questions, your comments. The guy there, hit all the different ways that you can hit us up. So make sure you do it if you haven't done so already. Social media, the website, the app, live, however you want to hit us up with your questions, your comments. Got a concern, an issue, or something you want to learn about in the world of futures options? We got you covered. Let's kick things off here with a bit of a comment and a question here from John Pagnola, maybe. He wants to know, looks like you were right about a sell-off lifting OIV, and the short-term OIV being, of course, the volatility index of WTI, of crude. So, he's saying it did pop, so thank you for that, John. But that's obviously coming off now. Now that we're in this new paradigm, what do you think it will take to budge the needle again? Well, he's kind of referring to what we were just talking about earlier with the vol spiking pretty aggressively and then coming off almost as aggressively earlier this week as the sell-off really failed to deliver any follow-through, and we didn't see the continued protracted sell-off south of the 40 handle, let's say, or something like that people may have been really worried about, and certainly would have continued driving that vol up. I don't know if we're in, maybe Nick, you have different thoughts on this, but I don't know if we're in a new paradigm yet. We certainly are a new range, but the vol is kind of right back almost where it was last week again. So maybe from a vol paradigm, I don't know if we're in a substantially elevated level, maybe a little bit higher than we were this time last week, but if this erosion continues as it seems to be, then we're going to be right back where we were from a vol paradigm, vol regime perspective a week ago. So I don't know if we're in that yet. Range-wise, yeah, I could agree with you. For vol-wise, maybe not. But still, what he asked? What do you think it will take to budge the needle again? Well, as it so happens, while I was reading your question, I pulled up the vol tools over here at Quick Strike. You guys can do a lot of this yourselves too, particularly if you have the full suite over there, and that will show you exactly what I'm looking at. Now, maybe we can put a graph in the show notes so you guys can follow along as well. But effectively, if you look at that will kind of lay out a lot of what the market is thinking and pricing in from a volatility skew perspective. And of course, we said for the lion's share of last year, we saw an interesting setup out in WTI where the puts were extremely rich, the calls were cheap, and so it was very favorable for bullish risk reversals, that sort of thing. Around November, when the OPEC event happened, we saw crude rally. That situation changed. The calls got pretty rich too, not quite as rich as the puts, but they had a little bit more life to them. Now that we've seen crude sell off, we are selling again in this range, and that's why we saw crude vol pop. Was of course we traveled down the volatility skew to the richer puts, and we saw that increase, but it couldn't sustain itself, and it kind of came right back in. But that's exactly what we're seeing now. So we're looking at the skew. It still has a similar shape. The puts are where the predominance of the premium is out there, but the near-term calls have a little bit of a bid to them too. So if we saw maybe a sharp, aggressive up move, it could potentially cause a bit of a stir. But I think still our safest bet for a new spike, as he terms it, budging the needle again from a vol perspective. I'm assuming you mean to the upside. So in that case, I think our best bet is still where the juiciest premium lies, which is, of course, to the downside. So an aggressive move to the downside, let's say south of the 45 handle again, should certainly move the needle again. I mean, if we blow back up really aggressively, past well north of 50 handle again, maybe some of that near-term call premium could essentially do that. But if we kind of slowly drift north, that's not going to do. We're going to see vol continue to come in that way as well. So, yeah, Mr. Nick, are you feeling that as well? Another nice sharp shock to the system to the downside? Is that probably what it's going to take to really, as our friend John says, budge the needle again?
Yeah, there were people talking about $30 oil or something. There were some headlines and stuff like that. I mean, again, I always preface everything I say with, I don't know anything but, right? So I just don't see us getting below the 45 strike just based on the action of the market. I mean, we pushed down hard on the 5%, 6%, 7%, tried to follow through, got to 47.5 or whatever it was. So, I mean, that would clearly going through the 47 strike would change the paradigm a little bit, because then I think you might see people sort of running for the hills in terms of trying to get that downside vol. It's already bid. I just tweeted out a vol skew for the May and the May and the June contracts. I also tweeted out a term structure last week versus now. But I think just looking at it, the fact that the puts are still bid at the money, I would think that you can take a look at the open interest charts, see which strikes have sort of the higher the higher OI numbers, and sell some puts below those high OI strikes to finance some cheap call buying, because I mean that's what the numbers are telling you. It's saying the puts are bid, and you can see where the ranges are. We've established the range, right? We were 47.5. We bounced back up a couple bucks, and we're in the 49 range if we get up over 50. But if you have the wherewithal to do it and you're smart about the strikes you pick, I think you can finance some potential upside. We may not necessarily get a vol pop, but we might get a move up as well. So you sell a put, you buy a call, you get a move, and your financed option is going to take care of that call. And even if that call comes in from a vol standpoint, you didn't pay that much for it because you financed it with a put. So I think the paradigm is looking for downside to finance some upside, because it makes me think that that's the direction that we're going to move, because I don't see us, again, not knowing anything, going back into that really low price range, but I see us kind of grinding up, and grinding up's not good for vol. But if you're gonna have those options on, then you might as well pay for them with some downside you're likely not going to see.
All right, good question there, John. Next up, we got a surprise product suggestion here, Nick, for a future show. We got Haymaker, and he says he has a question for Twifo. He said, "What about fluid milk as a surprise product for the next show?" Well, I don't know, Mr. Haymaker. Let's pull it up and let's see. We can see here if I can pull up the Twifo reports. The problem is there's a lot of different flavors, pun intended, of milk out there. You've got your class 3 milk, you've got your non-fat dry milk, class 4 milk. You don't mention in particular which one you're looking at, but I'm kind of perusing through a few here, not seeing a lot that's really budging the needle here. You got butter, you got all sorts of other things in the old dairy complex. But I will agree with you, it's not an area that we typically visit on the show, but it has, I think it's popped up once or twice in prior episodes of this program. And here, I think it looks like the class 3 is kind of where the action, quote unquote, is, including this week lighting it up to the tune of it was like June 15 puts with a whopping 623 contracts lighting it up this week. A good chunk of that opening, though. So interesting stuff here in at least these June 15 puts. But aside from that, don't see huge moves either in the futures or in the vols up a little bit this week. But again, nothing extreme. But your point is taken. Yeah, I think we'll keep an eye on some of these, shall we say, more esoteric products out there. And when they do have a little bit of a spike, we'll see if we can kind of work them in. Because one of the things we like to do on the show is, maybe surface some of the other products. That said, some of the big ones have been so dominant lately with their moves and their volatility and the questions you guys are asking about them, like the golds and the WTIs and some of the ags and others, that is kind of hard to get to, shall we say, the lean hogs and the class 3 milks of the world. But I don't know. Maybe now and then it might be nice to visit the dairy land. Even though, Nick, I am lactose intolerant, I should not stay here very long. But what are your thoughts about adding milk to the show?
Yeah, I try to pay attention. I think there's, and Haymaker could probably answer this a little better. I think there's some weird anomaly where the front contract, once it becomes the front contract, it doesn't trade all that much. From just based on in the ratio of the delta to the contract changes. I would encourage people to answer that question if they know it. But watching milk, it would be great if we could watch milk, because I know just from talking to some of the people that I get a chance to discuss the markets with that use the product or that want to use the product or that have discovered the product. I know milk is becoming a big deal for some brokerage groups as well. So and definitely for some people that are helping producers hedge their product. So it would be great to bring a new product online. Except the problem is, when you're seeing these, I think the April contract had a pretty good volume yesterday. So I think you got to look at the second contract usually to see anything interesting going on there. But we'll keep an eye on it and see if we can find anything. But you can be hard pressed to see, at least you don't see a lot of news moving the milk market, right? So at least maybe we're not seeing it. It's not stuff that's publicized all that much. So But we can try. We'll keep an eye on it. It's easy enough to go, right? In Haymaker, you can go into the TWIFO report and go take a look at it and watch during the week, and you see anything interesting. Or if you're trading or you're broking and you see anything interesting, just shoot Mark a note or myself a note over Twitter, and we'll make sure that we give it some time in the next show.
Yeah, if you're one of these milk fans out there, let us know. Hashtag milk fans. We had hashtag hog love before, hashtag milk fans. Or maybe hashtag lactose intolerant, depending if you're not a fan of all things dairy. All right, let's go. Here's a straightforward one, Nick. This comes from Amy, and she wants to know, what's the shortest expiry available for plain vanilla options? Well, I'm glad you said plain vanilla, because that kind of limits our universe a bit. You can get pretty short if you get into some of the more, shall we say, exotic products out there. But in straightforward plain vanilla options like the ones we're talking about on this program a lot, the ones that are traded, the futures options over there at CME, pretty much weeklies is the shortest that they get. Now they're adding, that said, they are adding more expirations to the weekly cycles. So there are multiple weeklies available now. We're seeing more interest from a variety of exchanges, and maybe CME will get into this group as well, where they're going to start adding what effectively could amount to in the future. Every day will have a weekly effectively. So you have a weekly expiring Monday, Tuesday, Wednesday, Thursday, Friday, all the way through. In which case, in that sense, you will effectively have dailies. We haven't really seen this materialize to a great degree yet, but it does seem like there is some impetus for that. So if you're one of these people out there who's really attracted by the short duration contracts, I know there are a lot of you out there who want weeklies, but maybe want to get even shorter, then it does seem like the inertia is in your favor. Things are going to start maybe moving that direction. So you could effectively have the dailies, and we got some. There are some popping off now. I think there are some. Nick, I know you know of some exotic ones out in the energy one that are kind of effectively maybe doing this right now. Actually, so you probably could even get some of this if you want the daily liquidity. You probably can find it in some places right now. Mr. Nick, what's your take here for our friend? Her name was Amy. She wants to know shortest expiry for the normal options.
Yeah. So as Mark mentioned, the weeklies are they're expiring weekly, so you can really find something that you need probably every single day. But there are one-day options in the crude oil and in the nat gas. There's those basically come on every day. There's I think it's 01, 02, 03, they all the way through 031. And if it happens to trade that day, then it has that number. But they're out there. I know there are some people making markets for it. They don't have a lot of open interest on them, but that's effectively, those are more, I think you can almost look at those as binary options. So I think those are going to start to come into play more and more as people are aware that those are available, and as the different platforms start to offer them. Now, another new thing that's going to be happening in the S&Ps at the CME Group is they're going to start offering the E-minis there and the big contract, but they're going to be offering Monday expirations. So you're going to have an expiration on Monday, Wednesday, and Friday. So really there, when you're looking at it, you're going to have a one-day option. On when you come into the market on Monday, you're going to have a one-day option, and then the next day you're going to have a one and a half or 2-day option to go into Wednesday. So you'll have a 1, 3, and 5-day option coming into each week. So that really should get you where you need to be in terms of the shortest expirations available. And the difference between the one-day options and the crude and and these Monday, Wednesday, Friday expirations on CME Group is that. And those are effectively, like Mark said, those are weekly options. They just happen to be expiring, every 3 days during the week. There's huge open interest in volume in those weeklies, and that's where the majority of the action is. If you go look at some of the reports, it is taking place in those short-dated options. So you have a highly liquid, active market with a good OI and good volume and tight markets that's going to be taking place in the E-minis basically 3 days a week. And on holidays, it'll be even tighter, right? Because they won't expire. And on a holiday, it'll roll forward or roll back. So I think that's where you want to focus if you're looking for some short day trade. And those become completely different animals. I think Mark will attest to it as well. Those aren't volatility products anymore. Those are really like almost coin toss type things or cheap gamma bets or whatever. I mean, you could trade, you could have your gamma swing from 80 to 20 in a matter of 30 minutes or a matter of a minute in a given day. So you can, you get something cheap enough, you can kind of use it as a teeter-totter to trade futures, right? So you get long or short just based on the option that you have bought or sold, and then you can either scalp gamma on the long side, or you can sit and watch and trade a range on the short side. But yeah, I think there's plenty of opportunity in those E-mini weeklies for you coming. And the Wednesday, Fridays already exist. The Mondays are coming out in a couple of weeks. So there's just a notice put out there that's going to be available. I think it's April, that first week in April. So that would be where I would look.
All right, that funky tune means we've come to the end of yet another epic foray through the world of futures options. Yeah, and I agree, Nick. We are seeing a lot of interest in this. I call it the uber short part of the curve for options. A lot of people writing in saying, what can I get? Effectively dailies. So we are seeing, I wouldn't be surprised if in the next year or so from now we see a lot of the major exchanges and groups out there offering something that effectively approximates this, which could be weeklies expiring every day or something along those lines, because there just clearly needs demand for this, and so someone's going to have to step up and fill it, and it's interesting to see. But yeah, if you want to get those, again, like Nick said, they are more kind of pure gamma plays, even more so than the weeklies themselves. So bear that in mind. They're very much almost a quasi-binary product at that point. They're kind of very much yes or no. But if that's what interests you, and clearly a lot of people are interested in that, check those out. You can play with the weeklies now, and as they add more expirations, you can get more choices there. And good stuff. I want to thank everybody who wrote in this week. If we didn't get a chance to get to you, we'll get you next week. Don't worry. Maybe we'll hit you up on Twitter with the questions or via email or something along those lines. If you have questions, though, send them in. We do love to hear from you guys. You don't always get to all of them on the show, but we do read them all and try to respond to them all. So hit us up. If you are, you have a question about the world of futures options, or maybe you want to just comment about Nick, I won't share those with him, don't worry. Or anything else you want to hit us up with. No shortage of ways to do just that. Like I said, even when the show is not on, even when we're in between episodes during the week, you want to head on over there, cmegroup.com/TWIFO, and you can generate reports. So it's not just only working during showtime. It works all week long, 24/7. So you can generate those reports whenever the mood strikes you. You want to see what's going on in corn or gold or WTI or maybe in the fluid milk. Whatever strikes your fancy, head on over there and generate all those reports completely for free. Then, of course, you can always level up to the even cooler stuff if it does indeed float your boat. Speaking of the cooler stuff, Mr. Nick, you guys are always cooking up cool stuff over there on the Quick Strike front. So what should our listeners expect in the coming weeks?
In the coming weeks, well, let's see. So, like I said, we're always tweaking TWIFO to try to make it a little bit more useful, trying to squeeze more information in there. You'll know, if anybody has noticed, we changed some of the buttoning to make it easier for you to move around. We added that quick skew column. We're going to add some more columns around the at the money, so you can start to see things like average volatility for like the 34-day option. So we'll give you a little bit of historical perspective there, so you can see where this particular days to expiration option has been trading over the last 7 years. So that should be interesting from a seasonal standpoint for like the crude and the corn and the beans and stuff like that. More so for the ags than anything else. And then we've done some tool consolidation to make things a little bit easier for people to use on some of the premium products. So if you are a premium user, take a look at some of the tools that have been condensed for your usage pleasure. And we're just, in general, I think we're trying to just go out to the open interest profile tool. We've added some good stuff out there as well recently. So, and there's a big one coming in the next few weeks. We'll announce it when it's officially available and out there. A big new replacement tool out on the CME Group website that we'll be discussing in the coming weeks. So just keep an eye on TWIFO. Look for the columns. We may open up that first row so you can click through and get some of the informational things that we talk about. So you can dive a little bit more deeply. And since that first contract is the one that's generally of interest, I think that's going to go a long way towards keeping people on that page even more during the week. So that's what we're looking at right now.
All right, thank you for that, Mr. Nick. And on behalf of Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, sending in such great questions. Keep them coming. Love hearing from you guys. And we'll see you next time right here on TWIFO.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered. With market data reports ranging from open interest to the term structure of volatility, QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.